Hi, this is Greg. Welcome to the channel. And if you're new to the channel, we talk about business and investment. And on this episode, we're going to talk about dividend investing in your IRA. This is one of the very exciting areas where you can create tax-free income and you can create a compounding effect that will create wealth for you for many years to come. And we're going to be talking about it, and it's coming up right now. Okay, so on this channel we've talked about high dividend stocks, we've talked about dividend plays, and I'm going to put in the description and also at the end of this video, if you watch it to the end, I'll put two really great videos that I did, one on Exxon Mobil, another one on Chevron, where I talk about the advantages of dividend stocks. But in this video, we're going to be talking about how to do this tax-free in your IRA, whether it's a traditional IRA or whether it is a Roth IRA. So the reason why you want to consider doing dividend investing in your IRA is for several basic reasons. The most powerful reason is that you can make a return. You can buy stocks that give off a very good cash dividend, and at the same time you have the opportunity for capital appreciation, meaning that the stocks can also go up. But probably the best, most compelling reason, assuming that you pick stocks that do well over time, is that you can do all of this investing and get all of the benefit of this tax-free. Now, why is tax-free investing in either a traditional IRA or a Roth IRA advantageous? The answer should be obvious, but let's talk about it, okay? In either one, let's talk about the two different types of IRAs that you have. In the traditional IRA, you are taking money pre-tax, meaning that you're taking pre-tax dollars before they go through the filter of taxation, and you're putting that money into your IRA. In the case of a Roth IRA, you're putting after-tax dollars into the account, but once the money is in the account, it accumulates, whether it be capital appreciation or dividends, they accumulate tax-free. The other difference with traditional and Roth IRAs is that when you take your money out of the traditional IRA, the money is taxed at that point in time because it was not taxed going in, but you've gotten the benefit of tax-free investing the entire time the money's been invested. The Roth IRA, on the other hand, the money goes in after tax. In other words, it's been taxed. So when you take it out, it's not taxed again, and you get the advantage of having that money accumulate and compound on itself tax-free. Now, which one to choose here is up to you and your tax experts. I personally use both of them, and there are advantages to both of them, but that's kind of beyond the scope of what we're talking about here because we're focusing on dividends. Now, when you're investing in dividend stocks in an IRA, the basic principles are no different. The only difference is you're doing it tax-free. So why wouldn't anyone want to do this? I don't know. There are a couple characteristics that you want to look at in dividend stocks, and let's talk about them right now. So the first thing is you want to look at companies that have a history of not only paying a dividend over many years, but also a history of growing the dividend. These companies are typically blue chip stocks, and for what I do personally and for what I recommend that you do, I would limit myself to larger companies that have a long history of paying dividends, largely what they call blue chip stocks. Now, blue chip stocks are larger corporations like Exxon, like Chevron, like AT&T, companies like this that are larger companies, and they've been around for hundreds of years, and they have a long history of paying their dividends. Now, once you've screened those types of companies and you look at what they're paying in the dividend, I personally, especially for the retirement accounts, I like to look at companies that are paying at least 5% or greater. You have these companies like Microsoft and Apple. These are, technology companies, and they do pay dividends, but they pay 1%, 0.5%. To me, that's not a dividend. That's just like a teaser or something, like a make pretend dividend. I'm not looking at this strategy for companies that pay 0.5% as a dividend. That doesn't excite me at all. So once you've filtered initially those types of companies, there's a couple other things to look at, okay? And what I look at is also there has to be significant chance and probability of price appreciation over a medium to long-term period. This is why I always try and time my purchases so that I'm buying at a historic low point, or I'm buying after the stock, for whatever reason, has taken a significant dip. The key to all investing, including stocks, is you have to buy them right, because it means the difference between making an extraordinary return or just a moderate return. The third thing I've looked at, and this was shown in a lot of the previous videos I've done, like Exxon Mobil, is that you have to make sure that their balance sheet has the ability to maintain the dividend in up or down markets in their particular business. In Exxon and Chevron, for example, we looked at their balance sheet. We saw a huge amount of cash on the balance sheet. We saw that both companies had low leverage, and we saw that they had tremendous buying power to be able to continue to pay the dividend in down markets, which they're currently experiencing. And then the fourth thing that I highly recommend, that I think is very important when you're looking at dividend stocks, whether they're in an IRA or not, is when you have these stocks that are paying 5, 6, 7, 8, 9, 10%, you want to take that dividend that's paid quarterly and you want to reinvest it in more stock. This methodology is called a DRIP program, Dividend Reinvestment Program, and all brokerages have this ability to do this. I do it on every stock that I buy in this particular category. And why do we do that? The reason we do that is we are taking advantage of one of the most wonderful concepts ever invented. And I think Einstein talked about this and was a proponent of it, and also Warren Buffett is, and that is the magic of compound interest. Now what happens in this compounding effect here is if you're getting a 7% dividend, and every time that quarterly dividend is paid, you buy more stock, over a very long period of time, the stock will accumulate, your return will accumulate, and you will be very happy that you did. And remember, all the things that we're talking about here, this is long-term investing. This is investing for retirement. This is accumulating money over a long period of time, and that is how you get the advantage of compounding. Now, since we're talking about compound interest, what exactly is compound interest? Okay, I could do a whole video on compound interest and the magic of compound interest, which is one of the eighth wonders of the world. But I just wanted to touch upon it really briefly here. Take a look at this chart. This chart shows you the effect of compound interest, okay? And really all it is when interest begins to compound on itself, it creates this upward line that you see. And you can see that if you're investing money and you are putting money into a fund, an IRA, if you get a line like this, you're going to be extremely happy, okay? Because those dividends are going to compound on themselves, and you are going to experience this sort of U-shaped line which extends up into the stratosphere, And these are going to be very, very attractive returns for you. I'm probably, I'm thinking about it here, I'm probably going to do an entire video on compound interest because it is such an interesting concept and a very important concept for you to understand if you are an investor. All right, so now that we've talked about some of the basics of dividend investing, let's talk about some specific examples of the types of companies and the types of plays that I'm talking about. All right, here is a chart, very simple chart of just some examples of the types of companies I'm talking about that I would seriously consider putting into this type of a portfolio or even as single stocks. One of my favorites in this downturn, because it pays such a great dividend, is Exxon Mobil Corporation. We ran this through the strainer that we talked about of all the basic tests that we have, and this one came out with flying colors. Its symbol is 𝐥𝐸𝐤, and it currently has a 9.6% dividend. When I recommended it, it was 10.4%. It's gone up since then, and I think everyone who acted on my recommendation at the time is very happy. Another really good one I think today is Chevron, CVX. Again, similar story to Exxon. Everybody hates the oil companies, so therefore their dividends are very attractive. 6.4% currently. When I originally recommended it a few weeks ago, it was I think 7.4%, and so that is a really good one. Another one that I particularly like and I've made a lot of money with in the past is Altria. MO is the symbol. Right now they are paying an 8.7% dividend. All of these companies have had a very long history of paying dividends and a very long history of increasing their dividends. Another one, which is an offshoot of Altria, is Philip Morris International. This is the company, they split the company into domestic and international. Altria is the domestic. Philip Morris International is obviously the international. Its symbol is PM. The stock currently pays 6.4%. And again, if you time these things so that you buy them when there's a significant sell-off, you can do very well on the capital appreciation side also. Another one I would look at is AT&T. I'm a little concerned about this one because they do have a lot of debt, and they did go off their main knitting, so to speak, and they started purchasing media companies, and they've had mixed results with that. So that one I would dig into the finances on that one to make sure they can maintain the dividend. But right now they're paying 7.3%. And then, of course, another one that I follow is Verizon. Lowest yielding one right now, VZ rather. Lowest yielding one at 4.13%, but that's because recently the stock has rallied. A few months ago it was paying a lot more, and that of course would have been the time to buy it, right? So all of these are just examples. You can do your own research, and I would encourage you to do your own research. I'm just making some suggestions here of different stocks that I would consider. These are all great companies. These are all great dividend payers, and these are all the types of stocks that I would look at. So if you take these great dividend paying stocks and you add to the high yield and capital appreciation that you can experience with them, and then you add to that the fact that in an IRA, whether Roth or traditional, you're doing this tax-free, this presents you with a vehicle that is very powerful. It is a proven wealth-creating strategy, and people in my family, my grandfather and my father, both utilized this form of investing to a very great extent, and they did very, very well with it, and I know that you will too. I'm going to be putting up right now 2 videos that are going to be an extension of what we're talking about here, and I hope you take a look at them. They are very instructive, and they talk a little bit more about how to analyze the company to make sure that the balance sheet can support continued dividend payment. And I hope you subscribe and like this video so you can be on board for future videos that'll be coming to you very soon.